Hello again, everyone. This is Gene Aaronsburg coming to you from hot as blazes Southeast Texas on Sunday, June 30th, 2013. Yesterday, the mercury hit 107 here in the Houston area, within 2 degrees of the all-time record high temp and the hottest ever in the month of June. Forget global warming. I'm convinced this heat wave is caused by the overabundant amount of hot air coming out of Washington, D.C. If we could somehow shut the politicians up, the temperature would easily drop 10 degrees. Gold and silver prices have been anything but hot lately. They've been ice cold instead, as the world seems to have bought into the central bank created illusion that the U.S. economy is finally recovering. Between the Fed and the U.S. Treasury, they've pumped more than $6 trillion newly created dollars into the system in just the past 3 years. So I guess you could say the U.S. equities market better be advancing with all that extra liquidity juicing the system. The Fed manipulating interest rates to all-time lows has also propped up the U.S. real estate market, adding to the collective sense that things are improving. Everything's getting better now. Why, just look at the stock market. Now, don't you worry about that summertime sell-off that's going on. That's happened the last 2 years. Everything's just fine. This week, gold fell another net $64, or 5% lower, despite a late-week $35 short covering rally. Silver outperformed gold this week in a relative sense, off just 2.5%. We always like it when silver's outperforming gold. Gold has come very close to testing the 50% Fibonacci retrace level of the entire 2002-2011 gold bull market, which indicates something close to $1,100 as an area to watch for potential overwhelming support. That coincides with the 61.8% Fibonacci retrace level if we start the Fibonacci meter at the last major turning low for gold at $681 in 2008. Call that downside target 1160. Gold came within a $20 bill of testing that level in the wee hours Friday, June 28th. Today I want to focus on the positioning of the largest traders of gold futures, the Commodity Futures Trading Commission classes as commercial. Commercials include producers, processors, gold merchants and bullion dealers, refiners, jewelry manufacturers, and sophisticated mercenary swaps dealers, some of whom double as banks, like Goldman Sachs. These traders are the natural hedgers in the gold business, who use futures to hedge longer-term price risk more than anything. This category also includes some of the bullion trading banks many of these commercial traders end up trading through. In short, no pun intended, the COMEX commercial traders, the big hedgers as we refer to them, are collectively the largest, best funded, and because they're directly involved in the gold trade, and because they're literally market makers in the gold biz, they're presumably the best informed traders of gold metal on the planet. This is a data table we use to track the positioning of the commercials. This past COT week, which runs from Tuesday to Tuesday, as gold fell another $90 or 6.6% down to $1,276, the combined commercial traders covered or offset another 8,907 contracts, or 21% of their remaining net short positioning, down to an exceedingly low 35,208 contracts net short. Let's put some context to that statement. Going back to October 2nd, 2012, with gold then $1,774 an ounce, the commercial hedgers then held a very high 269,270 contracts net short gold futures. Since then, gold has fallen, and fallen big, down $497 or 28%. For the same period, the big hedgers have reduced their collective net short positioning by a whopping 234,062 contracts, down to a tiny 35,208 contracts net short. So as gold fell just under $500 the ounce, from $1,774 to the 1270s, the commercial hedgers The people who have to hedge their inventories and financial exposure against a falling gold price have reduced their net hedges, their gold price insurance, if you will, by a stunning 87%. Let's look at it in graph form. This graph shows the net positioning of the commercial traders in gold futures since 2005. The graph tracks the net short positioning of the big hedgers. As anyone can see, the current low level of net hedges is the lowest on the chart, and therefore we have to look further back in time to find a time when the commercials had fewer bets that the gold price would fall further. That's the same thing as saying that the big hedgers are currently the least worried that the price of gold will fall further than they have been in 8 years. No surprise, huh? With gold currently in the largest correction since 1981 and having given back as much as $730 or 38% since its parabolic blow-off top in September 2011 near $1,923. We would expect the hedgers to have a small net short position under the circumstances today. Let's look at a longer-term chart then. This chart looks at the commercial net short positioning for gold for the last 20 years since 1993. And what we find is that the current very low commercial net short positioning is the lowest since August 27, 2002, when the combined commercial traders then only had 34,069 contracts net short, with gold then changing hands for $310 an ounce. The hyperbolic way to say that is with gold now in the 1270s, the big hedgers are currently about as worried the price of gold will fall further as they were with $310 gold. Incidentally, negative readings on this graph are actually when the commercials were net long gold futures. The last time the combined commercials were net long gold futures was on December the 11th, 2001, when gold was in the $270 range. Back to the table for a minute. We compare the nominal commercial net short positioning to the total open interest for what we call the relative commercial net short positioning, or LCNSTO, on our charts. That standardizes the LCNS data over time, and it helps us to understand whether the commercial hedgers are being aggressive or not. Recall in October of 2012, the commercials had that big 269,000 contract net hedge on for gold. At the same time, their net shorts were equal to a very high and very bearish 56% of all COMEX contracts. At the time, the commercials were net short just under 27 million ounces of gold, a huge number, then representing about 47 billion in gold hedged. Well, today, or rather on Tuesday, with gold knocked down by the Goldilocks believers to the 1270s, the largest, best funded traders of gold futures net hedge position was down to a stunningly low 9% of all COMEX contracts open. Their net hedges have fallen from about 27 million ounces down to just 3.5 million ounces, from $47 billion to $4.5 billion worth of gold hedged net. Let's look at the relative commercial net short position in graph form. This graph goes back to the turn of the century. What we find is that the current relative commercial net short positioning, the current read on how aggressive the commercial hedgers are, the current willingness of the commercials to take the net short side of the gold battlefield, is the lowest it's been since December the 11th, 2001. Those who were paying attention already know that was the last time the commercials as a group were actually net long gold, back when gold was still trading in the 270s and just 3 months after the 9/11 terrorist attacks. So what does it mean for those of us who think that gold has overdone it to the downside? Is gold done with its washout move? Was what we saw this past week the long-expected capitulation? Have the bears finally run out of Goldilocks believers to scare out of their gold positions? Or is there yet more pain to come for gold bulls? Who knows for sure? No one can see the future. No one can know in advance when people will once again collectively lose confidence in the Fed, the Bank of England, the European Central Bank, and the Bank of Japan, and the governments These guys are printing money like mad to prop up. What we do know is that the people who are considered the smartest money in the gold market collectively have their least net hedges as a percentage of the open interest since they were net long right after 9/11, when the World Trade Center lay in ruins and the hunt for bits and pieces of 3,000 American bodies was still underway, and gold was beginning to wake up after a 20-year bear market. In the U.S. alone, the Fed and the Treasury have printed more than $6 trillion in order to manipulate interest rates, artificially support the real estate market, and create an illusion of improvement. The Fed is literally printing the equivalent of all the U.S. deficit spending and then some, which just allows our politicians to continue to be stupid without immediate consequences. Meanwhile, Congress and the Obama gang have neutered the U.S. economic engine, saddling it with higher taxes, tons of new hidden taxes and fees, biggest job destroyer of our time, Obamacare, and burdened all of us with a mountain of regulations and government red tape, instead of focusing on what it should have, on making the environment more conducive for the American entrepreneurial spirit to flourish. The Obama camp has put up enough roadblocks to growth that even the Fed cannot paper over the damage. So, will the investment class, the funds and hot money that jumped aboard gold when it was rising, continue to dump their gold holdings if it falls further? Anything is possible, but the commercials, the people in the gold trade who have to hedge, are the closest they have been to being net long gold in 12 years. They're positioning as though they see little chance of further material reductions in the price of gold. And let's not forget that the U.S. is just one central bank involved in the ongoing currency wars. The Bank of Japan is currently involved in an unprecedented experiment, trying to reverse a 20-year period of deflation by attempting to create 2% inflation. That's with a mind-numbing 1 quadrillion yen of accumulated government debt. For those who have not yet watched it, we highly recommend viewing a recent presentation by Kyle Bass on the Japan problem. We are convinced Japan is, as our friend Charles Biederman says, the canary in the government debt coal mine. We thought enough of this particular video to put it on our private website as well as on our public YouTube channel. The Goldman Goldilocks crowd is feeling pretty good about now. We say, hunker down, friends, and hang on to your gold outside the banking system. We think you're going to need it. A storm is coming.